And welcome back once again, options traders. Well, not surprisingly, I've been getting a lot of emails about strategies during high volatility environments. And one in particular came from one of the traders in our group asking about vertical spreads. And his question was, are there things we need to be aware of when choosing strikes for vertical spreads during periods of high volatility? The answer is absolutely yes, but let's go find out what it is and why it matters. As always, before we get started, please be sure to click like and subscribe. It definitely helps to promote the channel and is really appreciated. So, vertical spreads during high volatility. Let's say that you buy the June 100 call and you sell the June 105 call. That's a vertical spread. You're long and short an option within the same expiration, but different strikes. Now, the thing is that most traders will sell the at-the-money options because of the high volatility. They know that the at-the-money option has the most volatility, at least in total dollars, not necessarily in terms of implied volatility, but in terms of the total dollars. And so that's why they lean towards selling the at-the-monies. But is that going to be your best bet during high volatility? So the real question we want to find out, how does it change the risk profile whether you buy the at-the-money or whether you sell the at-the-money? So to figure that out, we have to take a look at vertical spread behavior. So just understand that increasing volatility is synonymous with increasing time. So they won't change your option prices to the same degree, but they move the prices in the same direction and for roughly the same reason. In other words, if you increase volatility, you are giving the stock more chances to get to a higher price. Or we could keep volatility the same and just increase the amount of time to expiration, and that would also give you more time for the stock to reach higher highs. So that's what I mean when I'm saying that increasing volatility and increasing time are really two different ways of accomplishing the same thing. Well, obviously, going in the reverse direction will be true as well. Decreasing volatility will be the same as decreasing time. Now, here's where it can get tricky. Depending on the strikes, it makes the spread safer or riskier. So let's take a look at an overlay. We're going to put the stock at 100 and we are going to buy the 100-105 call spread that we just talked about. So notice that our graph uses the stock prices along the horizontal as usual, but we're just plotting different volatilities. So in all of these cases, these four different colored lines, they are all for the 100-105 vertical spread. But notice if we put this on with 20% volatility, it's the cheapest. The blue line sits the highest on the graph. It can lose the least, and it can therefore make the most. That's why it sits the highest over on this side. And then as volatility increases, it starts to shift down. So what this means is that if you maybe used to put the spread on at 20% volatility, and now the volatility is increasing in the market, you're going to find that it's going to get more expensive and have smaller profits. That doesn't necessarily mean it's bad. Everything is a trade-off, but why is this happening? Well, the reason it's happening, take a look at the setup. The stock is at 100, you are buying the 100 call and selling the 105. So to get to maximum profit, you need this stock to get to 105, 5 points higher or 5% higher. So now ask yourself, under what conditions do you have a better chance of the stock rising from 100 to 105? Certainly not with 20% volatility. You do have a chance, it's just not as good as if it were 40 or 60 or 80% volatility. And so that's what's happening as the volatility increases. Take a look at the 80% curve. It is the most expensive and it produces the least profits. And that usually catches traders by surprise because they go, oh, it's during a high volatility environment, it's riskier and therefore I should have more profits. That's not true. All things being equal, if you are selling the out-of-the-money option during periods of high volatility, that's actually a benefit for you. And remember, as I always talk about, you have to pay for benefits. Yes, it is a benefit if the markets are very volatile and you are selling the out-of-the-money. And so you're going to pay higher prices for that spread and get lower returns. So once again, that doesn't mean it's bad, which a lot of people automatically assume, because there's a better chance of getting this maximum gain. But now watch what happens if we flip this. What if we keep the stock price at 100, but maybe we sell the $100 call, and maybe we buy an in-the-money call, such as the 95, and that's what we're doing here. And look what happens. It flips. When we have low volatility, now that's the one that is the most expensive and has the lowest reward. It's going to have the lowest ROI. Now, why is that? Well, again, look at the setup. The stock is at 100. The spread is already at maximum gain. So if expiration were right now, if we had 10 seconds to go until expiration, that would be ideal because we know that this spread would be worth $5. Well, if time and volatility are synonymous, well, this isn't 0% volatility, but it's lower volatility. So that's the thinking that you want to step through to understand what's going on here. We'd like to have 0 time on the clock to get this to maximum value. If we could push volatility to 0, that would be the same thing. Well, we can't push it to 0, but we can push it to lower levels. So if we get lower volatility environments, you will pay more for the spread and have lower rewards. Now take a look what happens in higher volatility environments. Let's say at 80% vol, that same spread is going to be the cheapest and therefore have the highest rewards. Why is that? Because it's already in the money. You're already at maximum gain. But under high volatility, you have less confidence that it's going to stay there. This is, again, the same as maybe doing a 1-day vertical spread versus a 30-day or a 60-day. The more you push that time out, the less confidence you have that that spread is going to expire being worth $5. Because again, remember, that's what it should be worth right now if expiration were to occur this very moment. And so because the volatility is high, the market's going, I don't know if this is going to be in the money. I'm not willing to pay a lot for it. That's why the price is the cheapest. Purple line sits the highest on the graph, and it also therefore produces the highest maximum gain. Now, what if the stock is somewhere in between? Let's put the stock at 102.50, and we're still going to stick with the 100-105 vertical spread. Now take a look. They all cost about the same. There are differences, but they're not massive differences. And they all return about the same profits or the same maximum gains. So the thing to take from this is that if you are in very high volatility environments, or if it's changing, it's going from high to low, low to high, and you want to keep these spreads about the same, buy the spread where the stock price is roughly in between those strikes. And it just isn't going to make a bit of difference on your profiles. But if you're buying an in-the-money option and selling the at-the-money, it will make a very big difference, as well as if you buy the at-the-money and sell the out-of-the-money. And so hopefully this video will help you to keep track and to make sense of which times might be better for you, which types of volatilities, and which times may not be so good. But like always, it always comes down to understanding your options and your theory to make the best decisions. And that's always going to give you better results. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Options A to Z's Facebook trading group, and you can find a link in the description below.